$1 billion.
Yeah, in a single week.
Right, in just a single week. That is how much cold, hard cash just moved through one prediction market platform.
Just one platform, yeah.
Right, Kalshi alone.
Yeah.
And they're essentially betting that traditional Wall Street analysts are completely wrong about our immediate economic future. So welcome to the Deep Dive. Today is Saturday, May 16, 2026.
Glad to be here for this one.
Yeah, our mission today is to really administer a heavy dose of financial truth serum to the global economy. We're bypassing the usual TV pundits and diving into fresh, real-time data.
From platforms like Kalshi and Polymarket.
Exactly. We want to see exactly what the global crowd actually believes. Because, I mean, $1 billion, that's not just a rounding error.
No, not at all. And that $1 billion volume you just mentioned, that's really the entire reason this matters for you listening right now.
Right.
We're, long past the days when prediction markets were just these fringe internet novelties or like weird gambling sites.
Oh, yeah, totally.
What you are looking at now are high-velocity institutional-grade tools. I mean, think of a prediction market, like a giant global pair of scales.
Okay, I like that visual.
Yeah, so analysts and politicians, they can shout their opinions all day long, but opinions are weightless. Only actual, real capital tips the scales.
Put your money where your mouth is.
Exactly. And right now, an immense amount of capital is tipping the scales in a very specific and honestly somewhat alarming direction.
Well, okay, let's unpack this. Let's follow that money. Because if $1 billion is moving on Kalshi alone, we really need to know what they are actually buying.
And what they're buying is anxiety, basically.
Yeah, it looks like a staggering amount of that capital is flowing straight into macroeconomic anxiety, especially right after that recent April CPI report.
The consumer price index, yeah, that data shift was just jarring.
Seriously jarring. I mean, looking at the excerpts, the implied probability of the U.S. sliding into a technical state of stagflation by the end of 2026 has spiked sharply to 40%.
40%, that is massive.
It is. And meanwhile, the traditional soft landing narrative, the whole rosy idea that the economy just gently cools off, that has eroded down to just 21%.
It's completely collapsing.
Right. So it's like traditional Wall Street analysts are reading from this sunny, optimistic script, but the audience is aggressively buying umbrellas.
That is a perfect way to put it.
But wait, let me ask you this. If every major bank analyst is still going on TV and projecting a soft landing, why is the crowd actively betting against the experts? Who is taking the other side of this trade?
Well, what's fascinating here is that it's a mix. You've got highly sophisticated retail traders, sure, but increasingly it's actual institutional capital.
Like corporate treasuries?
Yes, exactly. Corporate treasuries and institutional investors. And to understand why they are betting against the traditional Wall Street consensus, we really have to look at the mechanics of stagflation itself.
Because it's sort of an economic straitjacket, right?
It is arguably the most terrifying word for an economist.
Just stagnant economic growth combined with high inflation.
Precisely. Usually, a central bank has levers they can pull. If the economy is stagnant and headed for a recession, they lower interest rates.
Right, to make borrowing cheaper, spur some growth.
Exactly. But if you simultaneously have high inflation, lowering interest rates is like literally pouring gasoline on a fire.
The inflation just gets worse.
Right. So on the flip side, if you raise rates to crush the inflation, you end up choking off whatever little economic growth you had left.
Wow, so you are truly trapped.
You are trapped. And what that recent April CPI report showed was this really stubborn, sticky inflation.
Okay, wait, let's define sticky for a second, because we hear that term thrown around a lot.
Sure.
What actually makes inflation sticky as opposed to just, normal inflation?
So sticky inflation refers to price increases in sectors that do not easily adjust downward, even when consumer demand drops.
Give me an example, like groceries.
More like rent, insurance premiums, or healthcare. Think about it, if the price of a used car goes up, it can easily come back down when supply chains normalize. Oh, right. Supply and demand.
Exactly. But when your commercial lease goes up or your localized energy costs rise, those prices tend to stick. They don't just drop overnight.
Oh, okay. So the crowd looking at this data realizes the central banks are just boxed in.
Right. But it's not just speculation. People and institutions are utilizing these specific contracts to actively hedge against that sticky inflation.
But how does a business actually use a prediction market to protect themselves from this? like practically speaking?
Good question.
If I'm running, say, a regional manufacturing company, and I am terrified of this 40% stagflation probability because my energy costs are sticky but my sales are dropping, how does clicking a button on Kalshi actually help me?
You use it as an asymmetrical insurance policy.
Okay, walk me through the math on that.
Let's say a stagflation environment would cost your business $100,000 in lost margins over the next year.
Okay, so I'm down 100 grand.
Right. You go into the prediction market
Hmm.
and you look at the contract for, quote, U.S. enters stagflation by end of 2026. And right now, that's trading at 40 cents, reflecting that 40% probability.
Exactly. So you buy those yes shares. If the terrible outcome happens and stagflation hits, those shares resolve at $1.
Oh, wow.
Yeah, you just made a 60-cent profit on every single share you bought.
Ah, I see the mechanism now.
Hmm.
So the financial damage happening to my physical business is mathematically offset by the payout of the prediction market contract.
Correct. You are hedging your real-world risk. So the takeaway for you listening is that this 40% number isn't just a poll, it's not a survey.
It's actual money on the line.
It represents millions of dollars of active defensive hedging by people who look at the sticky inflation data and realize the optimistic TV pundits aren't the ones who will pay their commercial rent if the economy stalls.
That is just wild. Okay, so if institutional capital is hiding in these defensive prediction contracts, it kind of makes me wonder where they're parking their actual physical assets.
That's the next logical step, yeah.
Right, like if the smart money is bracing for stagflation, where are they seeking a safe harbor? And looking at the commodity data, the answer seems to be the oldest bunker asset in human history.
Good old gold.
Exactly. Spot gold has firmly established itself above a historic threshold. We're talking holding firmly above $4,800 per ounce.
$4,800. I mean, that is a towering figure.
Yeah, massive.
And it perfectly aligns with those stagflation fears we just unpacked. Because historically, gold thrives in an environment of constrained global energy supplies and sticky inflation.
Because it's tangible.
It's a tangible, finite asset, yeah. It doesn't rely on economic growth to generate a yield, which is crucial when you were expecting stagnant growth.
But contrast that with the digital world, because this is where the data gets incredibly strange to me.
No, the crypto data? Right.
We've always heard cryptocurrency pitched as the new digital gold. Yet, when we look at the immediate high-velocity market tracking, whether Bitcoin can break $85,000 this May.
It's struggling.
Yeah, the contract holds a very cautious 26% probability. So what does this all mean? I really need you to explain this disconnect.
It's a stark contrast.
Are we seeing investors play heavy defense with $4,800 gold while acting incredibly hesitant to play offense with Bitcoin? Why isn't it acting like digital gold?
Well, what's fascinating here is that the prediction markets are exposing a brutal truth about liquidity.
How so?
It comes down to how these two assets fundamentally operate under macroeconomic stress. Like we established, stagflation means high interest rates to fight inflation combined with a slowing economy.
Right, the worst of both worlds.
In that environment, liquidity, the availability of cheap cash, it just dries up completely. People and institutions become highly risk averse.
They want certainty, not volatility.
Yes. Gold is the ultimate heavy defense. It behaves exactly as it has for centuries.
Right, deeply rooted institutional hedging.
Yes. But the cautious 26% probability on Bitcoin reveals that the general public still views crypto through the lens of a high-risk, high-beta tech asset.
Oh, so they don't see it as a safe haven at all right now.
Not in this immediate moment. It requires new, expansive liquidity entering the financial system to really drive aggressive price appreciation.
Got it.
When capital is tight, institutions park their money in the proven physical anchor of gold. They do not want to hold a highly volatile digital asset in the short term, at least not in this immediate May timeframe.
That is a fascinating duality. It's like a perfect snapshot of two completely different risk appetites reacting to the exact same stagflation fears.
Exactly. You've got the heavy defensive institutional money on one side and the hesitant retail money on the other.
But wait, if institutional capital is playing this heavy defensive game, where is all the retail liquidity actually going? I mean, the everyday trader isn't necessarily stockpiling physical gold bars in their basement.
No, they definitely are not.
And this is where the data pivots into an entirely different realm. Here's where it gets really interesting, because the everyday retail liquidity is seeking a totally different outlet.
Pure escapism.
Massive entertainment and technological optimism. Let's talk about Polymarket sports volume, because the numbers here are just exploding.
They really are.
We are looking at cumulative volume for the 2026 FIFA World Cup surpassing $529 million. And the tournament hasn't even started.
$500 million before kickoff.
Right. And Group D is seeing heavy action. The USA is an 81% favorite to qualify, followed by Turkey at 76%.
It's wild volume.
And furthermore, Polymarket just struck an exclusive multi-year data deal with Italy's Serie A. This is following similar partnerships they made with MLS and La Liga.
Cementing their sports presence.
Exactly. Does this Serie A deal basically cement prediction markets as the ultimate internet sports engagement tool?
It certainly looks that way.
But wait, do these massive sports numbers just prove that everyday traders are looking for a fun escape from the grim economic data we were just talking about?
I think that's a huge part of it. If you connect this back to the broader psychological picture, it makes perfect sense.
Really? Because on paper, it seems totally disconnected.
Well, think about the institutional outlook. It's incredibly pessimistic right now, right? Stagflation, hoarding gold.
Yeah, very doom and gloom.
But the retail crowd, the everyday people, they're pouring hundreds of millions into future-forward optimism and global communal events.
Like the World Cup.
Exactly. The everyday person is feeling the pinch of that sticky inflation at the grocery store. They can't control the central bank.
Right, you can't trade CPI data at the supermarket.
Right. So they pour their disposable liquidity into global communal events where they feel a sense of agency and, honestly, excitement. It perfectly illustrates the current psychological divide in the global markets.
And that optimism isn't just in sports, though. In the tech world, there's this massive push to...
Oh, the SpaceX market.
Yes. SpaceX completely dominates the, quote, largest IPO by market cap in 2026, unquote, market.
The conviction there is staggering.
Traders are fully convicted that it will test the $1.75 trillion to $2 trillion range by Q3. $2 trillion.
It's incredible.
Doesn't that just highlight that exact same psychological divide you just mentioned?
Absolutely. On one side of the prediction market ecosystem, you have the grim reality of corporate treasurers hedging against economic stagnation.
Clinging to $4,800 gold.
Yes. And on the other side, you have the retail crowd actively betting on humanity becoming a multi-planetary species with a $2 trillion space company.
That is such a stark contrast.
It is. A $2 trillion valuation requires an incredibly expansive, optimistic view of the future. The prediction markets are essentially the only place where you can see the receipt for both of these realities trading side by side in real time.
It's the duality of human nature, quantified with capital. I love that.
Right.
But, we've talked a lot about human-made constructs so far, our economies, our sports, our tech companies.
Right.
But the prediction markets aren't just pricing human-made events anymore. They're actually pricing the natural world.
The climate markets.
Yeah. This shows how directly the physical environment impacts our economy. On Kalshi's Climate Hub, there's a very active market tracking where their May 2026 will register as the, quote, hottest May in recorded history.
And what are the odds sitting at?
Currently, the S contract sits at a modest 14 cents, which implies a 14% probability. Now, I have to be honest here.
Okay.
Betting on the weather. This feels like ancient farmers consulting the old farmer's almanac, but just digitized and monetized for 2026.
It does sound like a novelty at first glance.
Right. So how is this actually useful to the public?
Well, if we connect this to the bigger picture, it's arguably one of the most critical metrics we've discussed today.
Really? More than the inflation data?
In some ways, yes. Because for the public and businesses, a 14% probability isn't just trivia. It acts as a live, crowdsourced tracker for upcoming summer utility demand.
Oh, I see.
It tracks heat wave anomalies across North America. This order book is populated by specialized energy traders, meteorologists, and commodities brokers.
So they're taking all these complex weather models and forcing them into a single actionable percentage.
Exactly. It's highly practical, real-time climate risk management.
Okay, walk me through a practical application. If I'm running a business, how does a 14% chance of historic heat actually change my operations today?
Let's put you in the shoes of a supply chain manager for a major grocery conglomerate.
Okay, I'm a supply chain manager.
Extreme heat across North America doesn't just mean people are uncomfortable. It means your fleet of refrigerated trucks will require significantly more diesel to keep the trailers cool.
Oh, wow. I didn't even think of that.
It means spoilage rates for fresh produce will spike if there are any delays. It means regional power grids will be stressed by air conditioning demand.
which could lead to localized blackouts at my distribution centers.
Exactly. The heat creates a cascading chain of operational costs.
So if traditional weather forecasts just say, expect a warm May, that is pretty vague.
It's entirely unquantifiable. But if you are watching the prediction market and that 14% probability suddenly starts climbing to 30% or 40%.
Because the specialized traders are pricing in a new severe heat dome model or something.
Right. You have a real-time early warning system. You can pre-purchase diesel fuel before localized prices spike. You can reroute your perishable goods.
And just like the stagflation hedge we talked about earlier, I could theoretically buy those climate contracts to financially offset the increased fuel costs my trucks are going to incur.
Precisely. You are turning the noise of climate anxiety into a manageable financial metric. For public utilities, agricultural firms, and logistics companies, this strips away the politics and the panic.
Leaving you with a hard probability backed by actual money.
Yes, exactly.
It is truly profound when you step back and look at the whole board. It turns the entire human experience, from the inflation rate to a soccer match to the temperature outside, into a quantifiable data point.
It really does.
Let's do a quick recap of the ground we've covered today for you listening. We started by following a monumental, record-breaking $1 billion in volume to see that the smart money is revealing deep stagflation fears.
Yep, that 40% probability.
Right. And we explored how that sticky inflation is driving institutional capital into a massive $4,800 gold safety net.
While leaving highly volatile assets like Bitcoin struggling.
Exactly. Then we saw the retail reaction, everyday traders seeking escapism and optimism with over $500 million in the World Cup and projecting a massive $2 trillion SpaceX future.
The great psychological divide.
And finally, we just unpacked how live weather tracking is providing practical, crowdsourced climate risk management.
And this is exactly why you, the listener, should care about all of this. Prediction markets provide a radically different lens to view the world.
A much clearer lens, honestly.
Absolutely. You aren't just hearing what analysts predict will happen in an op-ed. You are seeing exactly where the global crowd is putting their actual money on the line.
It's the truth serum. When opinions cost money, the wishful thinking evaporates. Which leaves me with one final intriguing thought for you to chew on as we wrap up.
Oh, what's that?
Since macroeconomic sentiment is shifting so abruptly toward these defensive stagflation hedges, will we soon see the crowd begin to price in a specific June Federal Reserve interest rate hike?
That is a fascinating question.
Right, because traditional Wall Street is currently swearing that the Fed will pause. But if the global crowd is truly this terrified of sticky inflation, will the collective wisdom of the prediction markets start forecasting a Fed rate hike before traditional analysts even see it coming?
Will the crowd front-run the Fed?
Exactly. It's something to ponder as we head into the summer. Will the crowd predict the Fed's next move before the experts? Thank you so much for joining us on this deep dive.
Thank you for listening. Keep an eye on those markets.